like that. So we say 9, 10, 9 equity. So equity, you first get for the parent, right? So just check for me the equity shares. You got the hard copy, okay?
Yeah, I do. Just a second. Okay, so the equity for the parent is
Those ordinary shares.
Ordinary share. Oh, the ordinary shares is 10 million for the parent.
Yeah, so we say 10 million. Which is just 10,000, right? Because what gets rid of the zeros, I think so.
10,000.
Yeah. And then now, what's the so remember when buying this subsidiary, there's what we call a share exchange. So on share exchange, you have to first find the ordinary shares that you're going to add to the existing ordinary shares, and then you also find the share premium. So here, to look at share exchange, right? So just read that adjustment for me that's relating to the share exchange.
Okay, it says 1st July 2024, Luapula Limited acquired 2.4 million of the 4 million ordinary shares of Mansa in a share for share exchange of 2 shares in Luapula for 3 shares in Mansa. The issue of shares had not yet been recorded by Luapula.
Yeah, so it's 2 divided by 3.
And it even says that the date of acquisition, shares in Luapula had a market value of 6 kwacha each.
Yes, yeah. So it's a 2 divided by 3, right? Then you multiply by 2,400,000, right? Those are the number of shares.
2 million, 2.4.
2.4 million, like that. Right? And then we multiply by 1.
Okay.
Right? So now, so these are the shares that were obtained as a result of the share exchange. Right? So you say 2 divided by 3 times the number of shares that were bought, right? And then times 1. And then now,
the times 1 is coming from ordinary shares, K1
yes,
per channel.
Yes, exactly.
All right.
Yeah. Then share premium. So you give me the share premium that's already in the top balance.
It's 300.
It's how much?
It's 300. 300.
Yeah, 300. Good. And then what is the share premium that's resulting from the share exchange?
Share premium from the share exchange. Did we read anything like that?
This one you find. So we say, right?
Okay.
We say 6 minus, right? 2/3.
Or the 6 that it says that Luapula had a market value.
Yeah.
6.
Yeah. A6, that's the share price for Luapula. So 2 divided by 3 times 1. Right, good. And then manage times the number of shares that were bought, which is 2,400,000. Like this saying. So here what we're trying to do is we're trying to find the share premium. So remember, the share premium is the profit on the issue of shares. So here the par value for each and every share is what? 1 kwacha. And then the market price for the parent's shares is 6 kwacha, right? So if we are issuing shares at the share exchange at a price of 6 kwacha, right? The nominal value is 1 kwacha. what is the share premium? So the share premium is just 6 minus 1, which gives us 5. So area 5, that's the share premium. And then you multiply by the total number of shares. So that you find the amount in kwacha. I don't know if it's clear.
Oh, why are we subtracting 6 minus 5? It's still the same formula.
The 6 minus. So we're deducting. So this
5.
is 6. This is the share price, right?
Hmm?
Remember, this is the share price, eh? And then
Mm-hmm.
2 were the shares in the parent that were given to the subsidiary, right? So we gave out
Mm-hmm.
2 for every 3 shares in the subsidiary, right? So this is the ratio.
Mm-hmm.
And then you multiply it by the 1, which is the par value, right? Then it's going to give us
Mm-hmm.
a nominal value for this share exchange. And then that amount, you say 6 minus,
Mm-hmm.
right? 6 minus what you find here, right? And it's going to give you
Okay.
the value of the share premium. And then you multiply by 2,400. I don't know if it's clear,
Okay. It's clear.
right? Why are we having a negative here? Okay, it's supposed to be this, like that, right? And then now
Mm.
we sum up everything, like that, like that, right? And then next, hello?
I'm getting you.
Yeah, and then next is the NCI. You remember the
And
format, right?
for NCI,
Yeah, next is the NCI.
forgotten.
So the non-controlling interest, this is the value of the shares that the company does not own. So if let's say a company has got 100% of shares, and then they only own
Mm-hmm.
80%, right? So that
Mm-hmm.
80%, right, is for the parent,
Mm-hmm.
and then the 20% is for the subsidiary, or for the NCI, sorry. So
Yeah,
the parent is 80%, NCI is what? 20%. So you have to find
20.
the value of that NCI. So we say NCI, right? We
Mm-hmm.
say the fair value of that NCI according to the format, right? And then we say equal to, so the fair value of the NCI is what we found here, more goodwill. So we get the amount that's in the goodwill, this one, right? For the NCI, this one,
NCI. Mm-hmm.
this one, that's the one that you bring here, right? And then you add, you add, right? You add the share of post-acquisition profit. Right, the share of the post-acquisition profit. So where does this post-acquisition profit come from? We still go to goodwill, right? Uh, the post-acquisition profit, oh, sorry, share, the assets acquired. So here the assets acquired you remember here we found the NCI to be 440, and then for the parent it was what? 660. So that same 440 we bring it here, all right?
Okay.
And then we go back to the retained earnings. We check if there's any, amounts that were shared, right? As you can see here, the unrealized profit was shared between the parent and the subsidiary. So you also bring the share of the NCI, right, for the unrealized profit. Because remember here it was said that it's the subsidiary that sold to the parent, right? So
Mm-hmm.
it means both the parent and the NCI, they had the share in that unrealized profit. So the unrealized profit relating to the parent, you have to post it to 10 earnings, and the unrealized profit relating to the subsidiary, or rather the NCI, you post it in the NCI account, right? So here,
Mm-hmm.
unrealized profit. So here we already found the value of the unrealized profit. Let me just do this. So the value of the unrealized profit. Where's D48? D48. Okay, so the unrealized profit that we found is 800,000. So I have to find the NCI's share of that 800. This unrealized profit. Where is it again? On current assets, this 800 like that. So we multiply by 0.2. I multiply by 0.2. Right? So the share of the NCI in the unrealized profit is what? 160, right? So the issue here is if there was any other item, let's say something like the goodwill valuation is full goodwill, right? It simply means we need to share, right, that impairment of goodwill between the uh, parent and the NCI, right? Even all other things that are incurred for both the parent and the NCI, right? We need to apportion them across the parent and the NCI. Don't know if it's clear.
Just repeat.
Yeah. So in the formats, there'll be things like
Mm-hmm.
impairment of goodwill. This simply means that
Mm-hmm.
goodwill has impaired. The goodwill for the parent has what? Impaired. It has lost value. Yeah. So if the goodwill is valued at full
Yeah.
goodwill, right, we apportion it between the parent and the NCI. So here in the retained earnings for the parent, you put the unrealized profit, right? And then here for the NCI, you also put the unrealized profit by multiplying by the uh, total ownership.
Okay.
I don't know if it's clear.
Okay. Then realized profit. How did you find it first? Maybe delete the 160. I see what you did again.
The unrealized profits were given the method that was supposed to use, right? Remember, it was said that the company bought goods worth. So the parent bought goods worth 10,000 from the
Okay. The
subsidiary.
800, I know how you found it. The
Yeah,
800 here, I know.
yeah.
Now I have a problem. Uko 160. How did you reach at 160?
So 160. So now this 800, we have to apportion it across the NCI, what the parent owns. So the parent owns 80%
Okay.
of the shares, right? So meaning
Mm-hmm.
NCI, rather, the parent owns how many?
80.
60%. No, I think it's 60%, sorry. 60%.
Mm-hmm.
And then meaning the subsidiary, or rather the NCI, owns 40%. Right? So we have to say that 800,000, right? We multiply by the share of the non-controlling interest, which is 40%, right? And that's how we arrive at this amount. So initially we had the 120 because we multiplied by 20%.
Okay. It's clear. I think I kind of remember this. I do remember this part. Mr. Kunda taught. I think you're right.
Yeah, so like that's this, then plus that, then gives us the NCI. So this is the total value of the NCI. So remember, if there were things like impairment of goodwill, where the goodwill impairs, and then the NCI is valued at full cost, right? You have to
Mm-hmm.
apportion that impairment of goodwill.
That is that same impairment we even subtract it up, isn't
Yes,
it?
you subtract it. Yes, you subtract it here after you apportion it.
If it's there, yeah.
Yeah,
I remember this part.
yeah,
For the financial position, that's what he taught us. He only taught us this one. The other one that you taught us, he didn't.
yeah. So now, after the NCI, you've got the non-current liabilities. What are the non-current liabilities?
Non-current liabilities, we have 10% loan notes.
Yeah, so 10% loan notes, right? So you get for the
So for the
parent,
Apula, so for the parent is 203,000.
right? 203,000, right? For the subsidiary,
For the subsidiary, 104.
10.
Yeah, in fact it's 104 million.
Okay, like this.
I don't know. So put my 1,000 up. Put the zeros. You know how you put the zeros on the 10,000, even on the 203 add zeros.
Yeah, like
It's
this.
203 million. Eh, 203 million, 203 million, and 104 million.
So that's the way it's appearing. Munankade.
Eh, eh, Number zeros pamoja if you're you had put.
Oh, but so this 203 is
It's
232.
fine. It's
Wait,
104 million, 103, 203 million. So you've written it just okay. Hey, now
okay.
adding ama zeros kumuru, isn't it?
Let me see.
It's just fine. You've written it okay.
I'll take the zeros.
Ah, there. Look, as you are going down, go down.
Yeah.
When you were calculating, we
Uh-huh.
assume that there are zeros on top.
Yeah.
Go down. Are you 900,000? Remember the zeros on top. It's just not a 900.
Okay. All
Return
right.
earnings 10,000. It's actually 10 million. How do you quit up? That's 10 million.
Okay.
So it's okay because we were assuming there are zeros on top.
Okay. All right. What? Let me just check. What year is this again? Just help me with the year of the paper.
The year of the paper is to December 2024. You've written it just fine. Supposed to be 203 million.
Yeah, yeah. So I want to be looking at it
So
as well. Yeah, so I'm trying to open it.
okay, 2024.
Yeah. So we said the 203,000 and the 104, right?
Yes.
Yeah, like that. And then we sum up.
Hello,
Yeah, then we sum up.
we have. So we sum up that.
Yeah, because there's nothing else. And then 4 of them, current liabilities.
For my current liabilities.
Yeah, what are the current liabilities? Huh?
So current liabilities, there's for the parent, see, it's 8,200.
So 8,000, 8,200, right?
8,200.
Right, and then
Mm-hmm.
Mansa,
4,200. Wachitako chena copy and paste. 4,200. 4,700. Sorry,
copy and paste
4,700.
yakuti.
Mungangati, if you're writing, you just get those. Okay, so we add.
Yeah. Then there were intra-group payables. So just read the intra-group payables.
Intra-group. I read which one?
There's a note, I think note number 6 or 5, somewhere there.
But other than where indicated, profit or loss items are deemed to accrue evenly over the reporting period. Master's
Look at
trade
one,
receivable.
number
Master's
7.
trade receivable. Master's trade receivables at 31st December included 600,000 due from Wapola, which did not agree with Wapola corresponding trade payable. This was due to the cash in transit of 200,000 from Wapola Mansa. Both companies had positive bank balances.
Right, so what are the payables there?
The payables, sorry, Mansa trade receivables include 600 due from Wapola, which did not agree with Wapola's corresponding trade payables. See 600 here.
600, right? Let
But
me,
I think it's 600,000.
so here what it's telling us, the receivables are 600,000, right? But there's a
Mm-hmm.
difference between the receivables and the payables, this difference of 200,000. So it's 600,000 plus
Mm-hmm.
200,000. It's going to give us a difference of what? 500 and what's this? 600,000 minus 200,000. It's going to give us a difference of 400,000.
400.
Yeah. So
Mm-hmm.
400,000, those are now the payables. So I say 400,000 like that. And then we sum them up.
Mm-hmm. All right.
Right? So that's it. So I think
Okay.
on the PPE, I think it's supposed to be 220,000, right?
Luapula PPE, let's say 40.
220,000.
240,000 actually. 240.
Yeah.
Mm-hmm.
Mansa, it's
For
210,000, right?
110,000. Mm-hmm.
Okay. So after we do this now, that's when we need to prepare the statement of financial.
Screenshot the last
Okay.
part.
We say consolidated.
Mm-hmm. I'll call you. They are flies, they don't know. Okay, go. Come on, look, they're flies.
What's the year end for this one? As at 31st what?
As of 31st December 2024. Consolidated.
Yeah. So we say consolidated statement of financial position. Right. To begin with the non-current assets.
Okay. So PP, property, plant, and equipment.
So PPE. Right.
You get the one that we found. Huh?
Yeah, we get the one that we found here. This one.
Mm-hmm. Investments.
Yeah, and then investments. Get the one that we found. Then next, goodwill.
So that's the total current assets. Huh? Or
No,
goodwill, sorry.
goodwill.
Goodwill will add.
So goodwill we get here in. Then investment in
Yeah,
associate.
that one, the 4,500.
Yeah. Then investment in
Investment.
associate. So investment in associates 900. And then now we total this. Then we now get the current assets.
Current.
The current assets are these 21,400. Right, and then we sum up everything. These are total assets.
Okay.
Right, and then now here with equity and liabilities.
Ordinary shares.
With ordinary shares. Right, the ordinary shares that we have here.
Equity.
Right, then you got share premium.
Yeah, share premium.
Coming. Okay. Right. So there's one thing I forgot to mention. So here what was supposed to sum up. We sum up these totals here like this. So what you get here, I just forgot to sum it up. The formula is a bit messed up. So
Yeah, just put equity.
so here we sum up the equity shares and the equity resulting from the share exchange like that. Then here we add up the share premium that the company had before the share exchange, and
And
then the share premium resulting from the share exchange.
the share exchange.
Yeah, and then you add the two like that. Right. So here the equity is this. The share premium is that.
All right.
Like that. There's, then also there's retained earnings. So what are the retained earnings? Retained earnings are these 85,780.
Retained is okay.
Then you sum up everything. Right? It's giving us a total of 63,180. Then you get the non-current assets.
Non-current
Right?
assets.
We had loan notes,
I
right?
don't know. So, but there's just only loan notes and current liabilities.
So loan notes. So this, right?
Loan notes.
Yeah.
Number 11.
And then current liabilities.
It's the last one, I believe.
Right? It's the last one.
They're down there. Are your current liabilities? There, yeah.
Wait, sorry. Just read for me the adjustment for the intragroup payables again.
Okay, intergroup, it says Mansa is trade receivables due from Luapula,
It's what
which did
four.
not agree.
The amount is 400,000, not 400 million, right?
It's 600. The first part is Mansa trade receivables at 31st December include 600,000.
Yeah.
They are not million,
Yeah. Okay. Yeah.
so
So
it's supposed to be just
yeah, it's
600.
supposed to be 400 chub, eh? Yeah. Yeah. That's why I made the mistake. Yeah. I saw it.
So it will be 400, yeah.
Yeah.
Let's try if we are close. Let's try to add. We see if we are close. Ngafile balance.
But I say exactly,
If
but I
close,
think the difference would be. So here some.
let's try to. Me, I think you are right.
Yeah, there's a small difference. So let's say
But you are close.
more. So let me do this. The balancing figure
Or you
here.
want to see the difference. Okay, try to see the difference. To able to watch the wrong. A difference can no.
Like that 1088. So that's the difference.
So that's what I do in the exam. Balance.
Eh,
Okay,
because it
okay,
won't,
very clever.
yeah, it won't be balanced because of the errors and the likes, but at
Mm-hmm.
least you need to demonstrate what I've done here. Then you can be able to get maximum marks. And then again, it's about the workings. So the workings are the math.
Oh, no, this is okay.
So you've seen how we've done the
Can I
workings.
take the waking? No, pan sharp for the waking. I want to take